Talking about the Fed, talking about the markets. What happened yesterday in the markets? A big rally. There was no trigger for it, no fundamental trigger. Everyone was walking, scrambling around, trying to figure out exactly what happened. Maybe easy, actually, and it may be as simple as Mark Hulbert is going to tell us from North Carolina. All right, Mark Hulbert, it almost depresses me to have to talk about this because it's like every time the market goes up for no good reason, people say what you're about to say, but what you're saying actually might be the truth.
We always run that risk, don't we?
Yeah.
I put the headline on what happened yesterday is "Don't fight the Fed." The news was so bad that I think it does clear the deck for the Fed to at least consider, probably more than just consider, some monetary stimulus. Now, of course, there are days when the news has been bad and the market's gone down, so it's difficult to try to explain any day's gyrations. But nonetheless, yesterday was quite extraordinary. The news out of Europe couldn't have been more awful. And yet here we have the Dow up so strongly. And gold was responding well. That is one of the differences. If you look back to what gold has done in previous days when the news was bad, gold was going down too on that deflation or disinflation story Spencer was talking about. This time it went up. And I think so you have both gold and stocks speaking with one voice yesterday that this probably clears the deck for Fed to stimulate the economy with QE3.
Right. Now, you know, it's very interesting because those Italian bond yields yesterday and the Spanish bond yields especially rising sharply, really in a danger zone. You would have thought that the stock market would have gone scrambling, running for cover, but they didn't. But I have to say, even if you think the Fed might act, the Fed might not, they might make things, another Operation Twist, another QE3. I mean, Europe is a fundamental problem, isn't it?
Well, absolutely. I don't mean at all this to minimize the problems whatsoever. What I have in my column on the site today is a graph that looks at how the stock market has responded to past sovereign debt crises. If we put what's happening in Europe in some sort of historical perspective, we find that there are sovereign debt crises all over the map over the last couple decades. I picked the last 4 of them and create a composite of how the stock market did in the wake of those over the next several years. And the stock market, of course, never goes in one direction only, but nevertheless, over the 2 or 3 years afterwards is up, what, 50 or 60% on average. We're not that far off the past pattern. And I think that is what, not just what happened yesterday, but it's that longer term context that gives us the confidence to say, you know what, the Fed has a pretty good track record, not perfect, but that's why I think a lot of people say don't fight the Fed.
Yeah, you know, last week the rally was in large part, I believe, predicated on the same thing. They were expecting central banks to do something. They didn't get it last week. Bernanke had a testimony, and he basically kind of, you know, kept the bat on his shoulder. He didn't swing. Do you think that they are going to swing next week at the FOMC meeting?
Well, at some point, I don't know whether it'll be next week, but I would imagine that it's going to reduce rather than increase the time between now and whenever the Fed does act. I mean, the news is so bad that I don't see how they can let it go much longer. The Fed and all the central banks have definitely signaled their intention to not let the economy spiral out of control. And I thought yesterday, as you were mentioning just a couple minutes ago, had all the hallmarks of the beginnings of that kind of spiraling out of control. And why would the markets respond so well in the face of that? That is the mystery.